Hi, today I'm going to talk about commodities markets, kind of their structure, what's important, and how they're related to recent developments in the news. A little bit of background is that the traded commodities fall into five categories. One is agricultural, which are regard grains, food, and fiber. The other is livestock and meat. There's also energy. An example of that would be oil and natural gas. Then you have precious metals, which are like gold and silver as we know it, and also industrial metals such as aluminum and copper. And in general, yeah, commodities have much higher risk and reward than that of stocks, and a large reason of that is leverage. From earlier in the semester, we learned that you need a 50% margin requirement for stocks. With commodities, normal investors, the margin requirements can be as low as 10%, and even 5% for that of CTAs and CPOs, as commodity trading advisors and commodity pool operators. They're like hedge funds of commodities, and with such low requirements, they're able to leverage their positions, and that makes the the amount of reward or loss much more significant than it would be if they had to put more money down. The general state of the commodities right now, on average, it's been flat to even slightly down in the past 18 months, and this is due to slower growth in China and the Eurozone recession, and also continued lackluster U.S. growth. And this lower demand, the commodities that have been most affected are oil and industrial metals. Regarding oil, when the demand goes down, so that things that are kind of related to it, such as gas, diesel, usage in like factories, trucks, ships across the country, also consumption, such as traveling much less. All of those things, when there's a lower demand, the demand for oil has gone down. And regarding industrial metals, not precious metals like gold and silver, but aluminum, copper, nickel, zinc, things that are used for like construction, pipes, components for buildings. Once again, the demand for all of those processes has gone down, and with that, the demand for oil and industrial metals has gone down as well. Another important thing regarding the markets for commodities and the influence of central banks. Right at the ongoing global central bank policies of growing money supply and zero interest rate policies, the effects that are happening is that there's going to be an increase in demand and price of precious metals over the long term, over time, and that's due to the fact that there's an intrinsic value to having gold or silver. There's value that a human sees in it. Regarding fiat currencies like the dollar, the euro, the pound, those are just promises by a government, and with a greater supply in fiat currencies that have no real value, they're just promises by the governments. That's going to make even all commodities too, not just that of the precious metals, but all of them over time should increase in value due to the large increase of supply in fiat currencies. And regarding the structure of agricultural commodities, these are mostly affected by weather. Prices tend to rise in droughts, unseasonal frosts or floods. Example, this was last June and July. Corn and wheat, there was a large drought, so the prices of those commodities went up 20% just because of that. Also, if there are frosts that happen in like South America, the price of coffee will go up, and other unpredictable weather in like California, Florida, that could drive the price of orange juice up. So the agricultural commodities are mostly affected by weather rather than policy and economic demand. And recent developments last week, one thing that was very important in the commodity markets and the financial markets, gold fell nearly 9% on April 15th, the lowest since the early 1980s. And it was due to the following reasons. Most importantly, Goldman Sachs just made a sell recommendation that Monday morning, obviously after they changed their positions, but there's just a sell recommendation on commodities in general. And gold is the most noteworthy commodity, and people started selling it. There's also the aftermath of the post-Boston bombing, And when people started selling, there were one or two large leveraged positions by hedge fund managers, and then those were long positions. And when the value started going down, they weren't able to meet the margin requirements, so they've liquidated the positions, and it caused the price of gold to go further and further down. And here's just a chart of gold the last month. As you can see, started in its highest level about a month ago, slowly went down, stabilized, and then on the 15th it just free falled. And in the last week, gold has recovered a little bit, about half of its losses. So it's been about a 4.5% loss total, as gold has recovered about half of what it did lose, but still significant loss in the long term, in the short term. And other commodities have been important. Natural gas and cotton have been the largest gainers recently. Cotton's demand has been pretty steady, while natural gas in 2007 and 2008, the price in the units that they're measured in went from $20 to $2 very quickly. And with that large drop in price, manufacturers, companies, they switched from coal to natural gas because the price of coal didn't change, but with natural gas much cheaper, they started using it more, and the demand quickly went up. Recently, it's stabilized a little bit. It's gone up to maybe 4.5 or $5. So it's gone up around 30%. Nothing significant like 100%, but it's going up, and that's why natural gas has been a large gainer recently. So the conclusion of all this is that the commodity markets are very volatile due to a large array of influences ranging from the central banks to the markets in general, and even to the weather for the agricultural commodities. And while they're not performing well in recent history, such as the last 18 months, the future is looking very bright due to a lot of forecasts. But with their volatility, who knows?